Retail sales just fell, but the cost pressure at the gas pump did not disappear. US retail and food services sales dropped 0.6% in July, while the national average for regular gasoline was back up to about £4.07 a gallon by August 13th. Wall Street sees weaker spending and starts shopping for a friendlier Fed. The consumer may be shopping for a cheaper gas station. That combination matters because weaker demand is not automatically bullish. If households pull back while fuel stays expensive, they lose discretionary room from both directions, less willingness to spend, and a bigger, unavoidable bill. It is the economic version of getting a coupon in one hand and a parking ticket in the other. The coupon helps, but you are still paying. The first place to watch is the household wallet. University of Michigan consumer sentiment fell to 51.0 in the preliminary August reading, down from 55.2 in July, and one-year inflation expectations moved up to 4.3%. That does not prove consumers are about to collapse, and one weak retail month can be noisy. But if softer sentiment is followed by weaker traffic and spending, discretionary businesses become more exposed. The second pressure point is corporate margins. Brent crude finished Friday at $88.52 a barrel and WTI at $82.40 after renewed tanker attacks and stalled US-Iran talks pushed energy prices higher again. If that pressure persists, transportation, logistics, packaging, utilities, and eventually consumer prices can become harder to manage. The Fed then gets the macro version of two dashboard lights turning on at once. Softer growth on one side, energy inflation risk on the other. The base case does not need to be dramatic. July retail weakness could partly reflect timing effects, including Amazon moving Prime Day into June, while the consumer remains resilient and oil settles back down. In that case, slower spending could reduce inflation pressure without causing serious earnings damage. Markets would probably prefer that version because it gives them softer demand without a fresh energy problem attached. The bear case is where the squeeze becomes interesting. If retail demand stays soft while oil and gasoline remain elevated, lower-income households are likely among the most exposed, followed by discretionary retailers, restaurants, travel-related spending, and companies with thin margins. A rate-friendly data point would not automatically become an earnings-friendly data point. The gas pump, unfortunately, does not accept dovish expectations as payment. The bull case is simpler. Consumer spending stabilizes, retailer earnings show healthy demand, and energy prices fall as geopolitical risk eases. That would break the two-sided squeeze and turn July into more of a temporary pothole than a new trend. So this is not a recession siren, it is a dashboard light. Watch retailer earnings, gasoline, crude oil, and consumer data together, because the real message is not that spending fell or oil rose, it is whether household cash flow starts losing room on both sides at the same time.